Edwin, welcome.
Thanks, Will.
Good. Okay, so Edwin, you're very involved in Brussels with the European Commission, sort of overview of the EU. So let's talk a little about tax, and particularly as it relates to Brussels. Now, last month, as it turned out, there was the European Commission, European Parliament co-hosted, I think, second EU Tax Symposium, and the theme was the future of taxation in the EU, challenges ahead and changes needed. Could you share some highlights with us?
Yes, that was very interesting. And despite the fact that the European Commission is heading towards the end of its mandate because there are elections in June next year, there's still a very active European Commission, a very active European Parliament. So last month it was really interesting. It was partly addressing the challenges, also to send some messaging, I think, to business, to the audience,
right.
And also thinking a bit about the new mandate of the new Commission, running ahead of that. And what I found the most interesting, I think, were the main topics of the first day. That was net wealth taxes and behavioral taxes, like green taxes. Very political discussion sometimes on behavioral taxes. The main topics on the second day were fair taxation. You can imagine what that is about. Resource allocation, harmonization of fiscal policies, and also a business framework for the single market. What I, getting a bit more into substance, found really surprising is that Vitor Gaspar, the head of fiscal policy of the IMF, floated the idea for an excess business profit tax in the European Union of about 5%.
Oh.
Well, first of all, is he the man to float that idea for the European Union? But he did, and that went down quite well. The EU Tax Observatory presented its report, Global Tax Evasion 2024, forward over Joe Tiglitz. You have read the report. I think it's not about evasion, it's about avoidance. And what's in there is a idea for a global billionaires tax, like a minimum tax we have for corporate income taxes. That's the idea Zoekman of the Tax Observatory has. I found that difficult because the net wealth tax was sort of presented by Tax Observatory and MEPs as a magic bullet.
Right.
You can solve all budgetary constraints with a proper net wealth tax.
Anything about growth and the tax system?
Well, that's the concerning part. Business was underrepresented in the panels, and the only one was the chair of Business Europe. That's all fine, but we need to think about pro-growth tax policies and how to remain competitive in the world. And I don't, have a problem with discussing wealth taxes and business taxes as part of the discussion on a future-proof taxation mix, but it's presented, as the magic bullet, and that's where I'm concerned, I must say.
Okay. So let's move on.
Maybe one thing that's on unanimity voting.
Yep.
Not surprisingly, I think Gentiloni, the commissioner, again said, well, we ought to discuss for the next mandate whether unanimity voting is still the appropriate mechanism for tax issues.
Yeah. It's worth pointing out that to abolish unanimity, you need unanimity.
That's indeed true. Yeah, you need to change the treaty. So that's yeah.
So let's move on to one of our favourite topics, the OECD pillars. And there have been some concerns regarding the compatibility of the OECD administrative guidance with the Minimum Tax Directive, which obviously was adopted before the guidance came out. Now, a draft statement was very recently released by the Commission. So just walk us through what the Commission's stance on this seems to be.
And that's the compatibility is and has been a concern. And I've been talking on that with people from the Commission in Brussels, but it seems to be falling on deaf ears, I must say. What the issue is that the EU directive only provides a derogation in the directive for safe harbors. So that is good, an important part, I think, of the current and future guidance. And the recitals with the directive also say that the model rules, the commentary and the examples provide for a useful source of illustration how the model rules work, but only to the extent that it is consistent with the directive or union law. And now we have this new guidance of the OECD of July, for example, on the safe harbors, but also on the transferable, marketable transferable tax credits, for example. And there's no mechanism to implement that in the domestic laws of the member states. So the directive doesn't have that mechanism, and the statement is interesting. It says it's a political statement to the member states. Please, be aware and be sure that we find this guidance consistent with the directive.
Right.
But that doesn't mean that this guidance is implemented in the domestic law of the member state. That has to be done via the domestic procedures. So that's
not self-enacting.
It's not self-enacting, and if anyone would suggest that is not true. So we're facing a very difficult situation.
Right.
For example, maybe one example, if I may, on the marketable transferable tax credits. That's an important part of the guidance of July, very closely related, what the Inflation Reduction Act is providing in terms of tax credits. So let's assume that we have an EU headquartered company that has a subsidiary in the United States, and let's also assume that the subsidiary uses a tax credit under the Inflation Reduction Act that qualifies as a marketable transferable tax credit. So without the implementation of domestic law, well, this company could face maybe a top-up tax in the European Union under the income inclusion rule, because there's no recognition yet that this marketable transferable tax credit is a qualifying. So, and I'm not sure what the consequences there. Well, first the company has to pay tax, but I think some people in the Congress, but also maybe the US administration, could be quite upset if that happens.
We'll definitely see. So let's just move on for one last question. So the European Commission has been very active in the tax area, putting out quite a number of proposals. We've had BFIT, we've had transfer pricing, we've had FASTER on withholding tax refunds, public country-by-country reporting, just to name a few. Which of these proposals or directives do you think is going to have the greatest impact on companies doing business in Europe?
Yeah, many of them will have. When you look at Unshell, for example, not on your list, and SAFE, it will have an impact, but that is pushed back, I think. Public CBCR already entered into force, will have an impact. Companies will have to publish data, but also, as you said this morning, we'll have to think about the narrative on tax. On the short term, I think FASTER has an impact. And Brussels loves acronyms, and FASTER stands. I have to look every time again. Starts for.
They caught that from the US.
It stands for Faster and Safer Relief of Excess Withholding Taxes, and it aims to encourage investment in the single market by making withholding tax procedures in the European Union more efficient and secure. So it's creating a digital tax residence certificate to give investors access to the fast track procedures, and that's still a refund procedure, not a relief at source procedure, which is, I think, one of the biggest shortcomings of this directive. The European Parliament, interestingly enough, is quite ambitious on FASTER. It says, well, countries that already have a well-functioning relief at source system shouldn't have to apply the refund mechanism, because that would be silly. On the Social Democrat side, they say, well, FASTER is important, but safer, and that's the second leg of the directive that addresses dividend stripping, is even more important. That's what the European Parliament says. Well, the Spanish presidency of the European Union, it has a rotating presidency, is now working on a new compromise tax according to the wishes of the Parliament. BFIT for the longer term could be very important. BFIT stands for Business in Europe Framework for Income Taxation. It's in fact a revamp of the common corporate consolidated tax base, which went nowhere. And BFIT provides for a common tax base in the European Union, a allocation mechanism, cross-border relief, a one-stop shop. Important features, I think. But when you look a bit more closely, you will see that the tax base is not aligned with Pillar Two, different adjustments. But also it adds a few own elements like on depreciation, stock valuation, etc. So in fact, a 28th tax base maybe. Allocation is not arm's length, it's not formula apportionment, it's using the tax basis of the previous 3 years, before the entering into force, which is on July 1, 2028, as a mechanism to allocate profits. That could have a perverse effect, that tax administrations want to increase the profit in order to get a bigger share when BFIT enters into force. So one-stop shop is only a one-stop shop for the information return, yet another information return for business. That's one of my concerns too. But the audit has to still to be done by the member states. So what we see yet is not huge support by member states. The Netherlands was quite negative about it. We hear that Germany is not in favor. So let's see where that ends.
Well, Edwin, thank you very much for joining us. There will obviously a huge amount going on in Brussels, so we will look forward to getting you back.
You're welcome.
Thank you.
Yeah, thanks.